one. Go ahead, Paul.
Hello, guys. Thank you for joining us. And I'm going to be talking about topographic finance and the 2000 financial crisis. And I'm going to be showing this in 4D, which is a 3D surface that is moving in time. Just to introduce myself, I'm an author. I've written 3 books about complexity science and behavioral finance, dynamic hedging, financial statistics, and my basic research is in chaos theory. I lecture about economics and finance, and I'm a proprietary trader focusing on energy and currency. And my dissertation title is Dynamically Hedging Oil and Currency Futures Using Receding Horizontal Control and Stochastic Programming. I'm still working on my dissertation. I'm about halfway through with it. All right, the 3 books that I have written so far is Chaos Theory and Economic Emergence, Black Box, The Alchemy of Finance, and Escape Velocity, Quant's Journey to Hell. My website is www.the-studio-reykjavik.com. So you can either subscribe, take a look at all the videos I do, or audio podcasts, I blog, download links, either market research that I've done, and my data for Poseidon, which is the software I'm developing. There's 2 new books that I'm going to be releasing in late this year and in early 2015. So the next book is going to be Surface, the Volatility of Volatility. This is going to pertain to my actual dissertation and how to graph that data. The dissertation is about dynamic market, and this book would go into detail on the dissertation. So hopefully I can have that published at the end of this year. Now, Market Armor is going to be in the beginning of 2015. That's going to be, most of the books that I have done have been related to PhD level, master's degree level in finance. Now, Market Armor is more of a little bit in terms of intensity of the mathematics that's involved, or the computer science that's involved. So it's more of an undergrad level book, maybe second year or first year master's degree level. So it's going to deal with chaos theory and complexity science and topographical finance, which is the topic of today. So let's take a look at what happened with the crisis of 2008. It was the worst crisis since the Great Depression for the 1930s. It resulted in the threat of the total financial collapse. It involved major financial institutional bailouts, failure of the money markets, and a severe recession ensued. And of course, governmental austerity and IMF conditionality onto several countries within the European Union. Now, this slide is showing the historical events that happened before the actual Lehman crash and what transpired after the Lehman crash and the mean reversion that was taking place after March 3rd, 2009. So I did a previous webinar, maybe it was a couple months ago, on topographical finance related to the crash, the Lehman crash. But that was focused more on a 3-dimensional perspective, and specifically to different markets and how they relate to each other. So I'm going to show a little bit of some slides from that previous lecture, but then go into the 4-dimension way of looking at this thing. So within this timeline, it all started basically around the third quarter of 2007, where BNP Paribas halted redemptions of investment funds. And so there was, and you'll see it in some later charts, what happened to the actual TED spread when this happened. So my theory, with using chaos theory as a foundation, is that there is endogenous signals, there's endogenous factors within a system that will give you kind of a hint, a whisper of future things to be happening. So some quants, they would say, oh, Markov chain paradigm in their model making, which basically means that the current position of a system will add some validity or some high probability of the future, the next period position of the system. And that can be true. I think in a lot of cases it is. But I think that there is also the memory of events that also transpire to the next time period. It's not just the current position of the system, it's also some of the history within the data set. And you can see this in the TED spread, which I'll show after a few slides after this. So after the Paribas halted the redemptions, then the Fed announced TAP and some swap lines between the United States and Europe, because they were short on dollars. There was a run, so it was kind of like a run on money, and these banks needed more dollars, and the Federal Reserve added swap lines to this. So in the news, if you start hearing, well, the Federal Reserve is increasing their swap lines to certain regions of the world, then that's a sign. And looking at LIBOR changes and looking at TED spreads, that's a sure sign that the system is going to start changing, normally to the downside in the equity market. So after that, in the first quarter of 2008, you have Bear Stearns having its problems, and it was basically forced to be purchased by JP Morgan. And then, and this chart's from Geithner's book, Stress Test, so I highly recommend anyone reading that book to read that book. So after that, then you're talking about the Freddie and Freddie fiasco that's taking place because of the defaults on subprime. And then shortly after that was the Lehman event, which was September 15th. Then TARP was passed. This is when Hank went to Congress for the bailout. And then after that, we're talking about unlimited central bank swap lines. Again, another sign of major stress happening in the system, which is similar to December 12, 2007. Then QE1 was announced, and then these different financial stability packages were announced around the bottom of the actual crash, which seemed to be around March 3rd, March 12th, March 11th, 2009, when it fully bottomed out and then the mean reversion started. So that's basically the timeline. Then there was, of course, later down the road in 2010, the QE2. So that's kind of the timeline of the event, what was transpiring. Now, what are some of the stylized facts of the crisis? So when you're looking at this thing from a quant point of view or an economist point of view, what does people want to look at? this is my suggestion. This is not exhaustive, but this is just how I look at the system here. How to look at the crisis in terms of system dynamics. Multiple markets have codependencies, so they move together at certain rhythms, especially if they're stressed. And the crisis had endogenous and exogenous factors. Part of these endogenous factors I already mentioned with the swap deals that the Federal Reserve and the ECB were doing early on in the crisis. And the exogenous factors are, well, one example of an exogenous factor here is the lack of fortitude within Congress when they went to try to pass, I think, TARP for the first time. When it failed and the market sold off, I think it was like 700 points that day, or maybe it was 900, I don't remember. And then markets, then you know, what type of markets to review. Well, this is not an exhaustive list, but you can get a good idea by looking at the equity market, the S&P 500, the oil market, because it's one of the most liquid future markets besides the bond market there is. The bond market itself, and I take a look at the 10-year, but I mean, we're going to be doing another webinar about yield structures in I think a couple of weeks, where you're looking at the full yield structure over time. It's a longitudinal study. So you look at the bond market, obviously that shows individuals running for safety, especially in treasuries. And then you can look at borrowing costs or spreads within the 10 spread or different spreads within LIBOR. The 1 month LIBOR versus the 3 month LIBOR and whatnot. So that's the way I kind of look at the market. So again, here's the equity market of the S&P 500 during our same time period. It's around 2007 all the way through 2009. So it's only partially into the mean reversion. And that's what that looks like. You know, here's the Lehman event and the crash. And, you know, the stability packages that were being passed around here. Then this is where it starts to get interesting. I want to state maybe 2 or 3 stylistic facts in this on this chart here. One is that you have the S&P 500, and then you have the oil market. And almost most people would say that oil, especially if it's moving in a power law type function, it's moving exponentially. There's some sort of exponential growth here. That should coincide with economic activity. You know, why would oil over 2007 to 2008 be in the speculative equilibrium, whereas the equity market is starting to fail? It seems discoherent. They should be moving together. So that's one major stylistic fact that I think helped exacerbate the crisis. One is from the perspective of just the average person in the United States. The cost to fuel their car, to fuel their home, became more and more expensive. And they probably were already in some sort of financial problem at this time period. And you know, maybe they were worried about their job, or maybe you know that you know their overtime is starting to abate, and they weren't spending as much. And this was being the actual spending in the society was starting to be shown in the revenues of the companies when they were releasing their quarterly filings. And so there was a slow retrenchment in the economy, and so was the equity market. It was slowly moving down. But there was a tipping point. Something happened where there was just too much stress in the system. Now, looking back on it, we realized, oh, it was subprime. There was a lot of CDSs and CDF primes, you know, and cubes, and you know, all these insurance derivatives that were betting against a lot of companies, and the underlying cash flows were stressed because people weren't paying their mortgages, and the system crashed because of it. But it's just interesting that speculative equilibrium in the oil market reaching some sort of parabolic function was one of the signs before the crash. And it was a leading indicator. It wasn't a lagging indicator, as you can see here. So that's what I wanted to say about the oil market relative to the equity market. Now, the bond market. Now, this is the 10-year bond relative to the S&P 500. Same data set for the S&P 500, and it acted relatively to how you would expect. As the equity market started slowing down, started to go down before the Lehman crisis, the yields on the bond started to go down. So that's a positive correlation there. Lower yields on bonds, a 10-year bond, with lower asset prices in the equity market. But what's interesting, and we probably will see this in the next webinar I do, is that you see here that something changed in the system. That when the equity market started to sell off more, that when the second derivative was increasing on the sell-off, that the correlation broke down on the 10-year bond and the S&P 500. And I think they had a lot to do with partially fear in the market, in the bond market, and the freezing up of the front end of the curve. And then it didn't snap back quickly until the intervention from the actual Federal Reserve. And then it went back into positive correlation with the equity market. So it was almost like a heart attack in a way, where the system, something happened in the system where the heart stopped, and electric paddles had to be put back, electrify the body to get the correct rhythm of the market. So that's one kind of metaphor to understand what was going on from a chaotic perspective. Now, here is what I was talking about, the endogenous signals in a system. Now, this is kind of related to my dissertation work. My data set for my dissertation is from 2005 to 2012, specifically in the oil and the Euro USD futures. And I view the LIBOR rate as a way to give an internal signal, an endogenous signal, that something is happening to the system. And you'll notice that when banks are having stress, when banks are having problems for funding, because they're normally, they loan out and they have to go to the commercial paper market and refinance regularly. But if those rates go up, then their refinancing increases, and the stress for the bank also increases. Now, remember in the timeline we were talking about BNP could not redeem their investments. This is when the spike in the TED spread started. And you'll notice that it's normally in a rhythm of about, I don't know, maybe about 3 months or so. Every 3 months there's another spike. and then it's almost like an earthquake. You know, so there's some tremors, and then all of a sudden a big one, right? So in a normal environment, like a mean reversion environment, you'll have a low tent spread, right? It's not so chaotic. But even looking at this curve, just looking at these curves here of the equity market, it didn't seem that bad. But you can't see the stress in this curve unless you look actually at some sort of volatility metric or some sort of funding metric. And here's a perfect example of using the TED spread as an endogenous leading indicator of future events, that a bigger correction is going to happen. Now, to go back to the oil market, I've been researching this idea that Dr. Sornet has about this periodic, it's called periodic, what's it called, log periodic function. So basically what that is it's a power law, but it's in a wave pattern. And wave patterns, the way it works is that the wave pattern is low frequency, and then as you get up higher, it's a higher frequency. So the wavelength shortens, but the frequency is higher and higher and higher. And it reaches a certain threshold and it crashes. So Dr. Sornet's research would say that this log periodic function here was another sign of a crash of the system here. Now, you can kind of see the log periodicity going in the down direction too. You can see that there was kind of somewhat of a wave here that's kind of low frequency, and then it gets tighter, a big sell-off, and tight before it starts to mean revert. So on the way down and on the way up, it's similar. You know, big wave, you know, big sell-off, everyone's fearful, and someone tries to mean revert, it can't, and then it goes down some more, but then it starts to abate, and then the energy to go down reduces, and it starts to mean revert. So this is kind of using log periodic functions and some sort of coupled with a mean reversion type methodology to model that dynamic. So you could see that log periodicity in the S&P 500, and then the endogenous signal from the TED spread. So volatility of the crisis of 2008. What's one way to look at it? Well, I like to look at things in 3D. That's just the way I like to work. One way, and it's the way that I showed in the previous webinar, it was a volatility metric, usually either of returns, normal returns or log returns, and then a correlation to something. In this case, it was either the S&P 500 to oil, or the S&P 500 to the TED spread or the bond market, and and then actually graph the log return. Or you could also graph drift. Sometimes I like looking at these surfaces more like a Black-Scholes model, where there's a drift component, there's a volatility component, and then there's a time component. So that's one way to cross-sectional the crisis and take a look at what's going on. Now, what I want to do is just kind of briefly show Poseidon and how and you can download it and play around with it for free here. So this is my website. Hopefully you can see it. And you go to thestudioreykjavik.com and you hit media, And this is where all my lectures, I got lecture videos, I got audio versions of all the lectures as podcasts. I have this Twitter feed. But you can go to this data files. And data files is all my webinars, like PowerPoints, PDFs of them, some market analysis before I was starting to develop Poseidon, and I was toying around with how to convey correlation before I developed this three-dimensional software. But then you can see this, I have Poseidon 4D beta, which is graphing the market in 4 dimensions, Poseidon Light, and Poseidon that does everything in 3D. And then I have 2 PowerPoints here that shows on how to read Poseidon. So you can just click those and download the data, follow the instructions, and then play around with it. So I just want to walk you through one where is it? So when you download Poseidon 4D and you install it, and you maybe copy it to your download folder or your desktop, you want to install this MCR installer, which you can either get from MATLAB or you can get it from my website. And then you just follow this. You want to make a folder, put it in your program files, make Poseidon 4D, copy after you, I think I zipped the file. So after you unzip it, you do this, and then you basically double click it, and then it'll calculate all these surfaces and put each time period in a folder and a movie. So once you click this here, it will read the data out of an Excel file, and it will make a movie, which is of the full time series, and it will put every single point in a figure, so you can do future reference, and then future analysis or whatever. Then you can go into this, and you can do modifications. You can go in and, again, this is the beta version of the 4D. But basically, you can paste any sets of data that you want in here. But basically, I put in time, I put in the value of an equity, and then you can calculate the return, and then what you want to compare it to, and calculate the correlation between the two assets and the volatility. In this case, I was calculating a 5-day moving average window. So you can play around with that. That's the beta version. Hopefully the full version of Poseidon will be out maybe in September. And then I'll take down the beta version. It will be no longer available. And the only thing that would be available is the light version, which is a little bit more easier to use. The light version, you just put any data set in the x-axis, y-axis, z-axis, and it'll create a 3-dimensional object for you using a biharmonic methodology for the surfacing. So I'll keep the Poseidon Light for free for anyone that wants to use it. But once I do the release of Poseidon the commercial release, I'll take down the actual beta version from the website. Now, okay, let's see. All right, now that's how you can get Poseidon if you want it. And then the walkthrough of Poseidon Light, I did. And now I want to show you the graphing of the 4D market. this webinar, what I did was I created 4 different scenarios, not scenarios, windows, surface windows is, I guess, the way to phrase it. I have a 10-day surface window, a 30-day surface window, a 60-day, and a 90-day. But when it's calculating the volatility and the drift of this, it's a 5-day drift moving window within a 90 or 60-day surface. So what do I mean by that? So the ones that haven't seen Poseidon at all, this is a 10-day window. That means it has 10 days worth of data. It's 10 days worth of data, and it has 10 points on the surface. You can see the points, right? And Poseidon uses statistics, and it prints out statistics to determine probabilities of particular variables, so you can use them in a quant trading environment. But in this chart, it's graphing time, drift, which is basically just a linear regression analysis over 5 points, and volatility. And then you know, a surface is created for each time period and stored in a folder. So that's a 10-day. Now what I want to do is show you the Excel sheet that loads into Poseidon. This is similar to the Excel sheet that I was showing you before. I downloaded all this data from the Federal Reserve, so this is all free data that you can easily obtain from the St. Louis Federal Reserve database for research. And you know, here I'm graphing I'm plotting the date, the value, the return, the volatility, and the drift. And you can see that I'm using line estimate as the function for the drift, and I'm using standard deviation for the volatility. And then the return is just normal return, not a log return. But it can be log return too, it doesn't matter. So, and then Poseidon reads this data, parameterizes the surfaces, and creates a movie. So, what I'm going to do is go here and show you, hopefully, 90-day API. Now you can load this movie in QuickTime or in the Microsoft player or any player to load up an API. I like the mPlay program within MATLAB because you can modify the frames per second a lot easier than some of these other packages. So what I'm going to do is I'm going to play actually the set of data of the S&P 500 from 2004 to 2014. So about 10 years worth of S&P daily data in a 90-day window, surface parameterized window, with a moving average of 5 days for volatility and for drift. And I'm gonna frame rate. I want to make sure it's at 2. I think I set it at 2. And then play it.
We just got a question. Go ahead. We just got a question from George.
Just hold on.
Yeah,
and
no
then
problem.
As this is playing, it's playing at 2 frame rates per second. And each day is a frame. And what you're basically basically seeing here is that you got time, and it's moving each time. You know, each point is another time. Each one of these points is plotting the volatility, the drift for that date. And if you wanted to stop something and say, well, you know, I find this area interesting in this video, I want to take a look at the time period 73222. This is MATLAB's way of putting an actual date into some sort of numeric. So you would look up that number, 73222, in the figure, 90-day figures, 73222. Okay, 7322. It's not reading all the way. Okay, let's just say that you wanted this 732297. So you load up that figure, and then you'd be able to say, oh, I like that area. I want to investigate that area more. And then you can actually turn it. The problem is that you can't turn a movie. So that's why you have to drill down into the actual static three-dimensional object to see it. But that's how you kind of use the 3D functionality inside. So as this is playing around here, I think, yeah, this should be still moving. Okay, so this is a 10 years worth of S&P data, daily data, parameterized using a harmonic methodology, biharmonic methodology. So I can take the question now.
Yeah. It's from George. Feel free to answer at the end of the presentation. Is the volatility calculated over the 5-day interval, and did you do this calculation?
Yes, it is over a 5-day interval.
Okay, I guess that answers that. Anyone else?
It doesn't have to be just 5 days. In the production version of Poseidon, you'll be able to pick which surface window parameterization you want and which moving average parameterization you want for whichever variable you're graphing. So you got to kind of remember that it's the surface window that's important, and also the window that you want to use for any particular variable. Now, from my experimentation on this, you want a larger window so you can see a larger window for the surface to see the wave propagate through time. And then you want, if you're going to be doing intraday trading, you want your data set, because these points don't have to be daily points. These could be actually ticks, or these could be every minute, or whatever time frame you want, whatever your feed is. You want basically 5 to 10 points for your moving window, for whatever variable you're using. If you want a fast moving but less accurate moving window, then a lower number is better. If you want a more accurate but more lagging indicator, then you would want a larger window. And you can play around. You can either use Garsh modeling. You could use exponential type moving averages within your methodology. It doesn't matter. It's the same. From a surface parameterization point of view, it doesn't matter. It's the same kind of method. It's just whatever you feel comfortable with, as a quant. Do you want to use standard moving averages or Garsh model? And there's many different types of Garsh models to begin with. There's different species of Garsh. So hopefully that answers the question.
Yeah, I don't think there's any other questions if you want to continue.
Okay, so that's the let's see here. Now I'm kind of pushing the limit on this the graphics card, and maybe go to meeting here. So pardon me for a minute here, because I'm gonna start. Okay, now that was the 90. Now what I'm gonna do is I'm gonna show you the 60 day at the same time. You'll notice there's a difference. Now, again, the 90 day has more data within the surface. The 60 day only has 60 days worth of data in the surface. And here, what you'll notice that the more the larger the surface window, the better the wave propagation is through time. The smaller the surface window, the more chaotic it is. And the reason why is because it's quicker that the first data points within the set leave the data set, and the whole surface is reparameterized with a new set of data quicker. So that's part of the reason. And you can kind of see that the dynamics of a volatility surface are much different depending on what sets of parameters you use, using the same sets of points. And this is similar to what you would see on a moving average curve. You know, on a typical chart, trading chart, you'd see the dynamics of a standard moving average versus, let's say, a 50-day standard moving average. The curves are much different. The 5-day is much more chaotic. It's much more jaggedy, while 50-day is more smooth. So you can kind of view it in those terms. But basically, someone would say, well, how do you use this in trading? Well, one is that you're only seeing the parameterization of the surfaces in a 4D environment. But Poseidon in the background is calculating the probability of the next point. I'm not showing it here, but it produces a PDF function and a CDF function. And you can use that in quant trading to determine, well, if the drift, in this case I have 5 days worth of drift, if the probability, the cumulative distribution is, let's say, 80% positively drift, then execute a long trade. Let's say if the cumulative distribution was only 0.4 positive, that means 60% is a negative drift, then execute a short trade. And Poseidon creates a signal that you would be able to read and implement that into a different execution system, or integrate that into your particular algorithm. So you just use Poseidon as a signal in a graphic interface to whatever quant system that you have. Another way, because I do spread trading in the energy futures market, oil and nat gas, those are high volatile markets. So I like to look at volatility surfaces, and how I'm seeing these daily volatility surfaces is that, well, when the volatility starts going down, it always starts to go back up because it's heteroscedastic. So what this basically means is that when the volatility is low, that's telling me that, well, there's going to be a big price move relative to some other variable, either drift or price or return or whatever, soon. So like down here, volatility is relatively, those points. Like right now, volatility was high, and now it's starting to drop down. Now it's low compared to the high point here. So now it's going to start spiking. See, it starts to spike. So it moves in a wave. Volatility moves in a wave, similar to that TED spread that I was showing you in the graph. That volatility begets more volatility in some sort of harmonic pattern. So that's the kind of the, the, the idea behind this. Now, when you take a look at a smaller time frame, you'll see the chaotic behavior that starts to emerge. Hopefully, the refreshing of this on the meeting here is okay.
Yeah, it's pretty good. It's refreshing. We also got another question from George as well, just so you know.
Okay. Let me just load this up.
Yeah.
I'm going to look at the 30-day, and you'll get an idea that this surface is much more chaotic compared to the 90 or 60-day, and it's still with the same 5 days moving average window for the individual variables. So now it only has 30 points to parameterize the surface, so it's a smaller surface, and that the data leaves the window at a quicker rate than the 90-day. So the 90 days here, and you can see that the surface is smoother because it has less points, but it also acts more chaotic. It's up and down in volatility much more rapid. So you can, this is like, the smaller the surface gets up to a certain point, it becomes more and more quantum, more and more chaotic, while a larger surface will allow for wave propagation to emerge. So this would be kind of similar to looking at price curves, and more at the tick level. But even though this is just daily data, but the movement of the surface is kind of like a tick curve. See how rapid, but you can do this. You can do the same things though. You can see that, well, volatility is low, it's going to start spiking. And then see, it just spiked. Then once it spikes, it goes down really quick. It's going to spike pretty soon here. See, it went really low compared to that, and it's going to spike. See, spike. So, so that's, different ways to read this. So I'll take that question.
He said, as George asked, how many days in advance can the leading indicator forecast price movement?
Well, I mean, it's I don't know how to phrase this. The leading indicator, it depends on the variable you're looking at and the way you parameterize it. So, like, for example, how do I want to say this? The volatility, when the volatility is spiking up, you know that it's going to start going down quickly. So it's almost an instantaneous indicator. Now, in terms of the drift is a lagging indicator because it is a linear regression of 5 days. So, it's a lagging of 5 days. If you had 10 days worth of data in it, or 10 points, then the linear regression would be more lagging than a 5-day. Similar to a 5-day moving average curve, a price curve is going to be much faster with the change in price, the current change in price, than a 50-day moving average. The 50-day moving average is going to be more than 50 days lagging. Now, you can closer to instantaneous, but not quite instantaneous, by using a exponential moving average, where the weights are more heavy to the current points in the data set and less in the previous points. The way these surfaces are parameterized at the moment, but they don't have to be, but they're parameters at the moment, and each point is of equal weight. So it just depends on how you prefer to do it. Or do you want, if you're going to be doing a linear regression, then you're always going to be lagging, have some sort of lag to price. because you could be a linear regression going up, right? The drift is going up, so it's a positive drift. And then all of a sudden there's a mean reversion, but the data set doesn't have it in the data, so it's going to be lagging. So that's why I'm not a big fan of, now this is a theoretical or philosophical point of view. The closer to the second, or the tick level, the more I think the chaotic the behavior is, and that linear regression won't work because you're working in a quantum point. But when you zoom out and look at it from the day point of view, you'll see things that are there are patterns, and that volatility will beget more volatility. So you can see here the wave propagation here is happening, but it comes out of the surface much quicker. Well, in the 90-day, the wave propagation takes much longer before it's out of the system. So you see the pattern longer in a longer data set. But I think that there's some validity to the 5-day moving window, or the 10-day, or I should say 5-point moving window versus between the 5 and 10-point moving window versus let's say a 30 or 40-point moving window. I think the 30 or 40-point moving window is too slow. It's too lagging. The only thing that's leading indicating is actually the volatility, because the assumption is that low volatility will beget higher volatility, and higher volatility will beget lower volatility. So they're inversely related. So it's like a coincident indicator.
Okay, but I guess you've already answered the question. He was looking for a specific example.
You know, but it depends. You know, again, it's like a price chart.
Yeah.
It's like a price chart. You know, some traders prefer to trade at certain moving averages than others. I remember the guy that taught me on the trading floor. He liked looking at moving averages that were. He looked at the. This was a day trade shop, proprietary shop, and he liked trading at the 10, the 20, and the 5 moving average. And he liked to see the curl of the 5-minute moving average. All right, because even though it was chaotic, he was always reading the MACD and the RSI, but sometimes the MACD and the RSI would give you a head fake during the intraday. All right, so that 5-minute moving average will move up, move down, move up, move down quicker than the 20 or the 10. So you get this kind of rhythm of the market, and that there's a pattern that happens at the 5-minute moving average curve, that once it starts showing a few points moving down, then it is a leading indicator relative to your standard MACD and RSI curling down indicators. So, you know, in day trading, you have really tight stop losses. So what happens is that if you can get head fake really easily. So he used that kind of like a 5-minute moving average as a signal to say, okay, it's not a head fake in the RSI and the MACD go in a certain way. Either go, you know, if it's going down, short it. If it's going up, long it. You know, if the RSI, the MACD, and this 5-minute moving average all lined up in alignment, and then do it. If you didn't have that, then what would happen is that you could get head fake because you're using a larger moving average curve, like a 10-minute moving average curve. It's not as fast moving with the market to be able to you'll have more head fakes within that curve than a 5-minute moving average curve. So that's kind of the methodology that's going on here. You have to parameterize, and the production of Poseidon is going to give the trader what parameters do you want. Do you want a 5-day, 5-point moving average, or do you want a 30-point moving average? You know, do you want a 100-day, 100-point surface, or do you want 250-point surface? The trader picks it, and whatever one that they're comfortable with is the one they use. But it could be, you know, there would be no added benefit of saying, well, I only want a 1-point moving average, right? Because it's not an average at all. So you had, you know, and once you start doing averages, they're definitely not going to be leading indicating. They're going to be lagging indicating. Moving averages, based on definition, are lagging indicating. But volatility, that's a different ballgame. Volatility is coincident.
Okay, I don't know if anyone else got any questions at all.
Okay, so now that's the 30, and now I want to just show the what was the 10-day. Now you'll see this is going to move more into a chaotic attraction. The reason why is that it has less data points, so it's more moving into a tick fashion. Let's see there. So compare it to our wonderful 90-day versus our 10-day. All right. Again, it's 5-day moving average window for the variables, but different time frames for the surface window. So you have the 90-day on the right, and you have the 10-day surface window on the left. So again, the surfaces are much smoother, but they're much more chaotic. They're acting more like in a quantum state, a subatomic particle state, than, let's say, molecular state. Let's say a molecular state is on the right, subatomic state would be on the left. In trade terms, this would be the tick. A good way to look at it is the tick. This is more of the candles within, you know, the ticks that make up a candle. So you can kind of see that, oh, you know, if you were in high frequency trading, you would want this surface. You would want to see, high frequency trading wouldn't do so well with the 90-point surface. It would be doing pretty well with trends, something more similar to lower frequency trading, more of a, you know, the typical technical trader may trade. This kind of surfaces would be very useful. But high frequency trader, this is what you want to look at, because this is telling you when volatility is low, it's going to spike quick, and when volatility is high, it's going to drop down fast. And this is it. You see the heteroscedastic properties of volatility with this. It's kind of mesmerizing in a way.
Yeah, it is.
But so that's Poseidon's nuts and bolts when it comes to using surfaces, 3D and 4D surfaces, to look at the market and make trading decisions. You know, again, Poseidon can be integrated into a full automated system if you want that way, or it could be integrated into a manual system where you're using the charts as to determine position, you know, determine entry and exit positions. And the surface doesn't have to be a volatility surface. Again, it could be any three-dimensional matrix that you want to look at that you think is useful in your trading. I prefer to either try to use volatility surfaces in terms of correlations or codependencies, or more like a Black-Scholes method. So that's that. And again, you can take any surface and Poseidon 4D functionality will put in figures so you can rotate at any time period that you really want to look at. So you don't see it in this demonstration, but there's probability distribution functions that could be called up to take a look. But you can see a probability distribution function, rotate a particular point, and see the market as it's moving. So you're looking at a static frame, that a frozen surface in time, and how it's moving, and you're seeing the market as it's happening, and say, you know what, I'm thinking of going into a position when the volatility starts to go down a little bit, and the drift parameter is positive. When my probability distribution says that the drift parameter is going positive, then I'm going to execute a trade when the volatility starts to go down. That's one way to do it. There's other ways, but that's one way.
We got another question. Go ahead.
Now the probability distribution function, that was in another webinar that I did with Brian. That was so product Poseidon. You can get product information from Poseidon on this page here. So the functionality of it. And you can graph. You'll be able to graph 2D, 3D, 4D. You'll get the probability distribution function, some artificial intelligence using some of the stuff that I'm doing in my dissertation. You'll be able to do some hedging. Anyone that does dynamic hedging or static hedging will be able to use these common models. You'll be able to produce a trade signal, calculate correlations of assets, reading from IQ feed, and then the volatility prediction analysis, which is similar to what you saw in the surface here. But the reason why I brought this up wasn't to show you my wonderful brochure, but this is what probability distribution function looks like. So in my case, the way I trade, I use thinkorswim. So I look at your normal price curve, right? Some moving averages, some Fibonacci's, MACD, RSI. And I compare that movement because you don't really see volatility. It's hard to see volatility within price. That's why that was the whole development of Poseidon. So you'll have a moving surface or a static surface, and that static surface will have a corresponding CDF or PDF function, and this gives you the probability of what that variable is based on the surface that was parameterized. So this would basically tell you what's the probability of the drift moving positively or negatively, and then you can place a trade that way, either manually, when you'll know where the current position is of the price, and you know the probability of when the price would be positive or negative, and then you can make a trade if it drops to that entry point or not. That's a manual way. The other way is that if a certain price is triggered based on the probability, send a buy signal to your broker. And Brian has shown a lot of information on Quant Labs about how to do that with Interactive Broker. So that's one way to do it.
Just so okay. We got another question. Just whenever you can.
Yeah, go ahead.
Again from George. In subatomic analogy, do you mean it would be like flipping of an electron from an upstate to a downstate?
I would say yes in terms of the volatility. Yeah. Especially in that 10-day moving window.
Okay.
Yeah, I mean, there's, one of the webinars about chaos theory that I did talked about when you graph returns, current return of the S&P 500 and the previous return of the S&P 500, daily returns it's in a chaotic state. That's a fact. I mean, when someone says that that they're serial correlated, daily returns are serially correlated, that is a lie. It's completely false. Now, what is correlated, what is serially correlated, is weekly returns and monthly returns, but not daily returns. And so when you move closer and closer to the tick level, you do not have auto correlation. They're not serially correlated. It's chaotic. You may be fooled that it's serially correlated, but because you're fooled by randomness, but it's not. They're not. So that's why when you go to the tick level or the high frequency level, it's a different ballgame. So it's more quantum physics than anything else.
I guess that's it for questions so far.
Okay. So probably to wrap this up. Okay, so that's basically Poseidon 4D's functionality. This is a quick return, graphing the returns of the S&P 500 normal returns and showing the heteroscedastic properties of those returns. This is during the Lehman crisis. So it's very similar to a volatility curve. This is a correlation, some correlation curves between S&P 500 for oil and for the 10-year bond. You can see here you have negative correlation, just like we were talking about earlier in the webinar, and then a fast snap when the sell-off in the oil market happened, and then you were in positive correlation. You already have seen surfaces of the S&P 500, but this is one this is when the Lehman event happened, and you can see the negative correlated points here. This is correlation variable, this is time, and then volatility. So as volatility started to come up, the correlation started to snap back into equilibrium. It's a natural state, which is positively correlated to the equity market. That's all that chart's showing. In the bond market, this is the opposite was happening. What was interesting here is that as the equity market started selling down, the bond market did not follow. It actually sold off also. So the yields were ticking up, not going down. Normally when the equity market goes down, the yields will go down. So the bond prices, the value of the bond goes up. So in this case, it wasn't happening. So that if you were a pairs trader, you knew that that's not a normal situation, and that you could make money when it started to mean revert, when the spread started to narrow. This surface shows this dynamic. It was positively correlated with low volatility, positively correlated with low volatility. Then all of a sudden we started having these points here started going seriously in negative correlation with higher volatility. So this dynamic here. You can't see the volatility of the price curve with time. But when you use Poseidon, you can. You see all the dynamics of the points, which is all these points here, right? But you how do I phrase this? You see how volatility is affecting the correlation. And then the TED spread. TED spread was this is the Lehman event here, and the correlation to the TED spread was extremely high during the Lehman event, which makes sense as the market was selling. Then you're going to have a spike in the TED spread. All right, now future development of Poseidon. I've kind of talked with Brian about this, some of the stuff I've been doing on the side here. I've been trying to move Poseidon into a virtual reality environment using something called a graphic engine. Terms that there's a 3D world that you can put things in it, which is called assets. You can put assets in a VR world. And then you can use different devices like gloves and head-up displays to see the data. The engine that I am experimenting with Poseidon is Unity 3D. So it's moving that data, taking MATLAB code and stitching it and putting it into Unity 3D using C# and JavaScript, and being able to be immersed with the data. So instead of rotating the data like you saw I was doing on the screen, you would be able to actually walk around the data. You could walk around the data and interact with it. So it would allow an immersive experience. And what's interesting, I trade a lot of different assets within the currency market, especially about 20 different currency pairs. And I look at, for each currency pair, I look at 3 charts. I look at a day chart, I look at an hour chart, and I look at a minute chart. On top of the parameterized charts from Poseidon. So you can imagine for 20 assets, that's a lot of charts. So that's part of the reason why I want to put it into a VR world, because I don't have enough room in for my trading platform to have 50 screens. I only have I think I have 1, 2, 3, 4, 5, 6. I have 6 screens. So so that's kind of the reason why. And what it'll do is it'll allow you to read the telemetry of the market in its totality, and then be able to determine correlations and joint dependencies for your trading. So that's kind of the future development of Poseidon. So that pretty much concludes my webinar. If anyone has any questions.
Anybody at all? Doesn't look like it. George, any more questions at all? Matthew says good presentation.
Thank you.
Anybody else? Small group in August, hot August. Yeah, I love that, man. What you've got going on with that charting. Once you can speed that up, that's going to be really, really, really hot.
Yeah, I mean it is kind of mesmerizing. There's almost an art to it, It's weird. It's almost like there's an aesthetic to it. It's amazing. I just can't wait to be able to integrate it into a VR world.
Oh, geez, that would be huge. That would be really big. Anybody else got any questions at all for Paul? Because you're back on the...
You can download this again on my website. You can download. You can go to my website, thereykavik.com.
Yeah.
And just look for Poseidon, and you can pull down the beta version. The light version is going to be just free. Now that'll be available even when I do the production. The beta versions will be taken down once I release the production version. So I highly recommend, if you want to play around with this. This is Windows based only for right now. And but I highly recommend, if you want to play around with it, to take the beta version, because probably in September or October, beta version won't be available.
Yeah. Any last comments at all? Matthew, just okay. We're just down a couple of people now. George says interesting presentation.
Yeah, the next presentation that I'm doing is going to be about using Poseidon in the bond market. I'm not a bond trader, but I do believe that the bond market is a good sign as telemetry for other things, for the equity market for sure, because it's usually negatively correlated. And so it can be a signal of risk aversion or no risk aversion. It could also show, when you look at different types of bonds, from different sovereign bonds, then you can see the movement of money globally, which affects the inflows and outflows and the need for a particular currency. So if there's a lot of inflows because of, let's say, interest rate differentials, let's say, for example, if the economy is relatively good in a nation and their interest rates on their 10-year bond is at 6%, but our interest rates are only at 3%, then a bond investor would say, you know what, I'm going to move my money and buy those bonds in the higher yielding country. Well, then that means that there's money leaving, a weakening of the currency in the low yield country and a strengthening of the currency in the high yield. So you can see this dynamic in the bond market and place a trade in the currency market to be able to take advantage of the price differential. So when you look at the bond structure, you don't have to be a bond trader. It could give you a lot of information of what's going on in terms of the economy in general. Because if it's an invert yield curve, then that means you're in a recession. When you're in, when it's not, then you're more into a growing economy. But also, and the differential between countries and the movement of money and capital flows actually plays a big part of the currency market. So it's important to be able to graph it and to be able to understand the dynamics. So in that webinar, I'm going to show how Poseidon can be used to actually graph yield structure and see on how that changes over time. And you'll notice that the yield structure of the bond market moves in a similar pattern as volatility. It's an up and down movement, but you wouldn't be graphing volatility. What you're graphing is time, maturity, and yield. So yield is your Z, time is your X, and your Y is your maturity of your bonds. So 1 month maturity all the way to 30-year maturity. And so you have the yield structure, and you'll notice that there's these wave patterns that are taking place through time that move up and down the front end of the curve based on the intervention, partially based on the intervention of the central bank, and based on partly on the demand for money based on whatever economic dynamic the economy is in at that moment in time. So I'm going to be doing a webinar on how to use Poseidon to graph it and how to interpret it for trading. And again, you could use that as a quant tool and not even be a bond trader. You could say, okay, if certain the change in yield, the yield curve is a certain way, I want to execute a certain way my currency trades or my equity trades.
Very interesting.
Yeah.
Go ahead.
So, but the bond market is that's a kind of a specialty. I'm reading a book right now on how to actually parameterize models for the bond market. And it's like it can get really deep in the mathematics of it. So I'm using Poseidon in a way to kind of like strip down the hard aspects of trying to parameterize yield curves and use the graphic engine of Poseidon to give more resolution of what's happening in the curve, in the yield curve.
Wow. George is asking, where is the link on your webpage?
Okay, so when you go to StudioReykjavik.com, go to products and Poseidon. And you click that, you scroll down, and you'll see these links here. Link for beta version, link for Poseidon Lite edition. Now that is the beta version for the 3D. This is the light version of the 3D. And if you want the beta version of the 4D, you can get that on the net meeting, or not the net meeting.
Go to meeting.
The meetup.
Yeah.
Meetup, right here. Link to the beta version of Poseidon 4D. Just click that, and you'll go to my Dropbox server, and you'll be able to download the 4D version. So you can. There's 3 versions out there. There's a 4D version, there's a 3D version, and then there's a light version for non-quants.
Sure that.
So hopefully that helps.
Yeah, I'm sure it does. Any other questions at all? Paul, your next one's on the 27th, right, of August?
I think so. I don't remember.
If you want to just go over there.
Always get this kind of blend together. Hold on. Let's see here.
I know it's towards. It's a.
I think it's in 2 weeks. I do have a question on the people that are online, though, just to do a little survey, even though it's a small sample size. Let's see, when is it?
It's top. Oh, you know what? Just go under the quant finance, like the meetup itself. Then you'll go under. Yeah, just go under the quant finance, yeah. And then on the left, it'll say future meetups, upcoming meetups. Yeah, that's it. So.
Summer powwow
It's tomorrow. Yeah, and then 27th. So that'll be a really good one. I know nothing.
Okay, it's called Longitudinal Study. Yeah, it's 27th. The Longitudinal Study in Modeling Yield Structure in 3D.
Never done fixed income, so that'll be a really good one.
I hope so.
Yeah, better numbers too.
But I'm gonna have to do the summer powwow.
Yeah, well, come on out.
Let's see here. All right, I'm going.
Yeah.
See that technology? Uh-oh.
Oh. Gotta love those graphic cards.
I'll tell you, the intensity of this on this laptop is it's pushing it.
Yeah. Yeah, so that thing's tomorrow night.
I'll sign up for it. I'm not sure if it clicked or not.
Well, it's.
But the question I had for the group is the ones that are still online. How many are there? 4?
Yeah.
Do do you see the benefits of virtual reality in trading?
I'm sure George will be, or John. Anybody got any? Oh, John says absolutely.
Mm-hmm.
And what about you, George?
Now for
the younger generation.
So for a I'm 42 years old, so I'm an older guy, I guess. But
Yes.
I was always fascinated when I first read about virtual reality back in 1986 or 87, and when I was younger, I remember playing a virtual reality game. It cost like $10, and you couldn't do much. You just walk around and jump on cubes and stuff. But I was always fascinated with it, and it was a shame that it never took off really because it probably was just too expensive. The computers at the time for the home didn't have the graphic power that they do now. That's another part of it. But I was surprised that it never really took off. But there does seem to be this threshold that has been broken. That the price of computation at the home level is equal to what I had in automotive in 1991. I was working on Silicon Graphics Unix boxes for drawing cars, three-dimensional parts and CAD/CAM kind of stuff on Silicon Graphics. We now have the power at the home level, at that level, if not maybe more. And now I see this huge industry emerging in VR. Now my specialty is in finance, right? So and I've always been fascinated with technology, especially VR, but never really was able to really play around with it until just recently. Primarily because of all the game development that's taking place now for computers, but now with Oculus being out, at a low cost at about $350, you can get gloves for about $600 to $800, and you have these graphic engines that you can program like Unity, and then MATLAB has a lot of capability in terms of processing capability. Actually, there are people that do gaming that use MATLAB as a rendering engine, code that's coming out of MATLAB for rendering for Unity, for games. So there's a lot of capability out there at the home level to be able to do some amazing things. The problem I see is that there's this learning curve of how to interpret the data. I see the market in 3D. There's maybe some people don't, so there's a learning curve on that. But I think that it's going to be a big industry, but I'm not really sure how many people would actually buy a virtual reality trading system or an econometric modeling system for a virtual world, for a virtual reality of the real market. I mean, this is not a game. This is loading real data, market data, in a virtual world and being able to see it and trade it in the real world. How much would someone pay to do that? I mean, if someone like myself took Poseidon and put it into the VR world and sold it for $200 or $300, would people buy it? Or would they not? Would they think that it's a bargain? I mean, is it a system that should be $2,000 or $3,000? I don't know. Because it's such a new thing. you know, what price points should there be? And I don't know. Any thoughts on the ones that are online?
Anybody? I know. Hold on. I just want to just point out that John says he'd love to calibrate on building a VR environment for this kind of big data. Another comment came in. Can your system be integrated with SolidWorks? And a VR software as a service might be the better way to monetize something like this.
Well, in terms of the first question about SolidWorks, the architecture, you know, I come from an engineering background. You know, I spent many years in engineering in automotive, so I know a lot about CAD and CAM and CAE, a lot. And, you know, the systems I worked on were CATIA, Unigraphics, and IDEAS, SDRC. And I didn't work in SolidWorks. We worked with the OEMs on their particular platforms that they were using for their vehicle development. So the idea is that you could build a three-dimensional object, or what is called in the VR world an asset, and you build this three-dimensional object or scan it. You can scan something. You can, like in automotive, we made clay models of the car and we scanned them and made surfaces from the data sets of the scan, and then we used that as a skin, and then we created parts from the scan. In the movie industry, they make dolls, and they scan the dolls like Toy Story, and they can articulate them in different types of software, and then load them up into a world, and then move them around and create scenes and record the scenes. So CAD of any type is very useful to build the assets, to design the assets. SolidWorks could do it. It can port it. Autodesk could port it. With AutoCAD. They have Maya. They have Alias. Alias I've worked with in automotive. And you can import these assets into a graphics engine. They have standard formats. A lot of them are tessellated formats where it's taken an STL file. An STL file is like a similar file that you use for 3D printing or stereolithography when I was in automotive. And so you can build these things in a CAD world and then import them into the Unity world. Now, the Unity or the graphic engine, whatever you want to use, but I like Unity 3D. It doesn't make an asset. You import assets and move them around in an environment, and then you have code like JavaScript or C# that controls the environment, adds intelligence to the environment. And then you could also link it with MATLAB through C# to be able to do unique features. And that's what I'm doing. The platform that I'm using is the Unity 3D as a graphics engine for the VR world. Poseidon is heavily developed in MATLAB and ported out to C#. And those are, MATLAB and Unity are integrated into a VR world, and then that VR world is exported out as an executable. And those drivers are all set up in Unity 3D with the Oculus head-up display. And I'm going to be purchasing what is called Control VR. Control VR is the sensors for the body. So you have I have two gloves in the Control VR that sense body movements of the hands and the fingers, and it's like moving a mouse or articulating hands in the VR world. So I could actually move a cursor with a Control VR glove and be able to control the screen in a normal Windows environment. Or I could be in the VR world and I could say, you know, certain hand gestures do certain things. In one case, it might be a certain hand gesture would be show me the parameterized surface of the S&P 500 on the right hand, and on the left hand, a certain hand gesture might be show me a parameterized surface of the bond market, and it pop up in front of you. That's one way to do it. You know, another way is to you know, certain hand gestures would do certain types of telemetry or to do a buy or sell signal, you know, to a function that would send it to Interactive Broker to make the trade. So it's kind of integrating all these things together. So I'm not going to be specifically using SolidWorks, but I have seen in the VR world people using SolidWorks and Autodesk for the asset creation within Unity. Now, in terms of the monetizing question, I'm not really sure what SaaS is.
Yeah, software as a service where you have it on a website, and then you have your back end on a remote server, and then people would pay, let's say, a monthly fee to get access to the service through a browser.
I see what you're saying. Okay, I see what you're saying. So it's kind of like what Bloomberg is.
Yeah.
You know, I've toyed around with this idea with Poseidon. You know, should it be something that's more server-based, or is it something that should be a downloaded program? I'm not really sure which way to go. You know, I'm thinking a subscriber-based model is probably a better business model than a non-subscriber-based business model.
Yeah.
One, it's a lower monthly fee for monthly cash flow for the person buying the service, so it's easier on the pocketbook. Plus, it's more stable in terms of revenues month to month for the company.
Yeah.
So that's probably a better model.
I can just from architect.
Now, the thing is, even if it was a subscriber-based model, you know, Poseidon being able to give, let's say, its current functionality of graphing a 4D or a 3D surface, any asset, with any variables that you pick, or any window that you pick, how much would someone pay, you know, for a service like that a month? Maybe $10. I don't know. You know, maybe $5. I'm not sure. You know, I'm not really sure how people would use it for trade. For like the individuals that are online right now, how do they trade? Do they manually trade, or do they do long-term investing? Are they automated traders? What kind of traders are they?
Anybody want to answer that? Anyone? I think a few of them are into just starting out, you know, building some kind of system before. Oh, manual trade options. There you go.
Okay, so if you're a manual trader of options, you're probably not doing high frequency manual trading, right? You know, you probably put in a few options, and then you know, it's more of a swing kind of thing, or you might hold it for a month or whatever. So in that case, you know, a lower frequency manual trade type environment might be actually pretty good, because it may give you confirmation to use Poseidon when you're augmenting it with your other strategies. Again, you know, how I use Poseidon is I compare price charts that I see with sink or swim. Yeah. And I look at the services that are created with Poseidon. So I don't view it as supplanting, Poseidon supplanting a trading platform. I see it as augmenting a trading platform. But as time goes on and the development of Poseidon becomes larger, then it won't need that 2D functionality from the broker. All I need is really the execution screen. So in those cases, I think that they may be very useful for a trader. But how much would a manual option trader pay a monthly fee for Poseidon? Let's say so George, I mean, if you were to purchase Poseidon, for in a subscription environment, because you're trading options, volatility is really important to you. So how much would you be willing to pay for Poseidon if you were to purchase it as a monthly fee?
Yeah,
a few bucks a month would be good, or
what George says he no high frequency. I'm not sure what he'd be paying. But John says he's only focusing on the tech side, and the trading's not been good to him. Here John says I wouldn't pay for it, but would think seriously to invest into it.
Okay, so when I'm on the stock market, when Poseidon's on the stock market, you'll buy stock.
Yeah.
Hopefully you'll buy call options.
I think he means more on a partnership level. George says, set your price, offer initial discount to attract customers. Get testimonials.
Yeah. See, this is the thing that the same problem happened with early adoption in VR during the 80s. Great idea. Technology worked. It was subsidized by DARPA and NASA and the military complex. But for commercial applications, it wasn't there. This is ahead of its time. I know this thing is way ahead of its time in terms of integrating this into finance and econometrics. I'm probably 20 years ahead of my time in this. But I know for sure that trading will go this direction.
Oh,
for sure. But the question is, what decade?
John had a comment.
By the time it becomes, widely adopted in the industry, I'm going to be already 65 years old.
John said you should see his retro VR helmet from the 90s.
Hey guys, does this day sound familiar?
I don't know if you got that.
No, am I supposed to click something?
No, it's a comment from John.
Oh, yeah, I saw that.
Yeah, okay. I mean, what
it is that people, this is the problem with the society that we have today. Is that we have a almost a commoditizing society. Where the technology is just freebies. Everybody wants freebies. Everybody, anything that's a digitized format. You can almost see it in the book sales. Books before ebook, usually were about $40-50, right? Now, 60% of the cost was production of the book, right? Now, the production of the book, the marginal cost is almost zero, if not zero. But the sales, drastically in terms of money, from the sale, is way lower. Ebooks now sell for less than $10.
Yeah.
The profitability per book is high, but people, the people aren't making money So the comment that someone made about the hedge fund thing, where was that? Someone made a comment about it's the way you market it or something.
Let's see here. The price depends upon how you wish to market your product, e.g., public, hedge funds, banks, etc.
See, George mentions this, price, increase price after your product is proven. Well, that's the thing, is that this method is no different in terms of validity and accuracy as the current price to time curve. The broker comes out with a trading platform. They give the trading platform free. They make their money through the actual brokerage fees.
Yep.
And they didn't prove out. They didn't have to prove out anything. I mean, it's the way the trader reads the chart, and then it's the same thing with the site. There's nothing to prove. It's the way the trader wants to read the chart, and how their pattern recognition or their ability for pattern recognition is what has to be proven, not the technology. So the only way to really to get more people to purchase the product is really they have a friend that did it, and then they're seeing that they're seeing the market in a different way and seeing opportunities that are arising that they wouldn't see in a normal chart, because there's dynamics in that price chart that are at higher dimensions that the price chart doesn't reveal easily. And when you look at it at multiple dimensions, you can see what's in that price chart. That's what the whole premise of this is. So when people see that there's opportunities that are coming up, then they want to mimic it. Those traders want to mimic those traders that are using the technology. So, that's probably where, the future lies in trying to get that take rate for people to buy the software. Because Brian knows that, I've been playing around with the surfacing thing since January or February.
Yeah, quite a while.
To get to this level of development.
Yeah.
But it's taken a lot of time.
Yeah.
To do it. But it's interesting. But I just, like anything, if there isn't money in it, then the development will start to slow down. It's only when there's money in it that where the development will start to speed up.
I don't know if you saw George's latest comment. Is your customer believe in your product?
Right. Right. Exactly. It's really belief, right? There's a belief in it. I would use also the word confidence. There's a belief and a confidence in themselves in using the product.
Yeah. Any more questions or comments for Paul? We got some new people aboard. We got Edwall, and we did have somebody else.
Edwall?
Edwall, yeah, we have somebody else I noticed as well. Syed, but he's gone.
So, Edwall, have you been on some of the other lectures that I've done, or no? Have you seen some of the lectures I've done?
Oh no, brand new.
No. Is this your first one with Brian, or no?
He sounds familiar. Second, yeah.
Yeah.
Well, welcome.
Well, I'm gonna be doing another webinar in a couple weeks. And thanks, John, for showing. Appreciate it.
Yeah. And same. Anybody else got anything to say? Thanks for coming out, John. Take it easy, man.
Thanks.
Anybody else?
So Ed, well, I just wanted to mention that I'm going to be doing another webinar in 2 weeks or so.
Yeah, 27th.
About the bond market. So hopefully you can show and see some of the technology that's coming out that I'm doing for 3D modeling.
Yeah. Hopefully this will get recorded. Well, the recording comes out okay. It should be okay.
I hope so.
Famous last words, right?
Right. Okay. I mean, that's pretty much it. I didn't have anything else to show.
Hey, man, as always, it's always appreciated doing this.
Yeah, no problem.
And I'll definitely put this on YouTube if it survives the process. It should. Please render. That's all I'm saying about this video.
Right.
I guess that's it for tonight. If I see you guys tomorrow night on the open-ended Q&A powwow, same bat time, 7 p.m. Eastern Standard.
Okay.
But thanks again, Paul, for doing this. I'm sure I'm hoping to have a bigger number on the 27th.
Okay.
All right.
Yep. Thank you for participating, George.
No problem. Yeah. Thanks. Yeah. Thanks, George. Thanks, Edwall, and everybody else that came out today.
Good.
All right, man.
All right. Later.
I'll talk to you guys later. Have a good night.
All right.
See ya.